A house that cost $200,000 in 2010 now costs $600,000.
Your salary didn't triple. Rent didn't triple either. So why does it feel like homeownership has become impossible almost everywhere on Earth? This isn't just happening in one city or one country.
From London to Los Angeles, from Lisbon to Sydney, the story is the same: prices climbing faster than wages, and an entire generation locked out of owning a home.
Let's break down what's actually going on and whether this counts as a housing bubble. What is a housing bubble?
A housing bubble happens when home prices rise far beyond what incomes and rents can justify, driven by speculation, cheap credit, and the belief that prices will just keep climbing forever. It's not really about houses becoming more valuable. It's about people buying homes as investments rather than places to live, which pushes prices up independent of what a typical buyer can actually afford. The tricky part is bubbles are only obvious in hindsight. While they're happening, everyone has a reason why this time is different: better cities, higher demand, limited land.
Sometimes that's true.
Sometimes it's just the story people tell themselves right before prices fall.
How we got here.
After the 2008 financial crash, central banks slashed interest rates to almost zero to keep the economy moving. Cheap borrowing meant cheap mortgages, and cheap mortgages meant people could bid higher and higher on the same limited number of homes.
At the same time, construction slowed down in many countries after the crash.
Fewer new homes were built for over a decade, while population and demand kept growing. Less supply, more demand, that combination alone pushes prices up.
Then add investors.
Large firms and individual buyers realized that instead of leaving cash in a bank earning nothing, they could buy property and either rent it out or wait for the price to rise. Entire neighborhoods filled with homes bought purely as assets, not as places for families to live.
And finally, remote work changed things again.
Suddenly people could live anywhere, so demand spread out of expensive cities into smaller towns, pushing prices up in places once considered affordable.
Why wages didn't keep up? Here's the core problem: wages are tied to productivity and local job markets.
Housing prices are tied to interest rates, global investment flows, and speculation.
These two things used to move together. Now they don't.
A worker's paycheck grows a few percent a year, if they're lucky. But when investors with access to cheap credit are competing for the same limited housing supply, prices can jump 10, 20, even 30% in a single year. A regular salary simply cannot compete with global capital chasing the same asset.
The rent trap.
For people who can't buy, the alternative is renting, but rent has been rising just as fast.
Landlords set rent based on what the market will pay, and if buying a home is expensive, more people are forced to rent, pushing rental demand and prices up too. This creates a trap. You can't save for a down payment because rent eats too much of your income, but you can't stop renting because you can't afford to buy. A global pattern, not a local one.
What makes this moment different from past housing crises is how widespread it is. In previous decades, housing bubbles were usually tied to one country's specific policies or banking system. This time, similar price surges hit Canada, Australia, Germany, Portugal, and the United States almost simultaneously. Different governments, different regulations, same result.
That's a strong signal the root cause isn't local politics.
It's global. The same ultra-low interest rates and the same flood of investment capital moved through nearly every major economy at once, inflating housing costs everywhere in parallel.
A look at the extremes.
Some markets show just how far this has gone. In Canada, the average home price relative to average income has stretched to levels unthinkable 20 years ago. In parts of Australia, buyers now routinely take out 30 or even 40-year mortgages just to make monthly payments manageable. In Portugal, cities like Lisbon and Porto saw prices climb so fast that many locals were priced out of neighborhoods where their own families had lived for generations, as foreign buyers and short-term rental investors competed for the same limited housing stock.
These aren't isolated stories.
They're previews of where other markets may be heading if the same mix of cheap credit and investor demand keeps repeating.
Is this a bubble, or the new normal?
Some economists argue this isn't a bubble at all, it's a structural shift. Land is limited, population keeps growing in major cities, and construction hasn't kept pace.
In that view, high prices reflect genuine scarcity, not speculation, and they're not coming down anytime soon.
Others argue we're in a classic bubble, inflated by a decade of ultra-cheap borrowing and investor speculation, and that rising interest rates in recent years are already causing cracks, slower sales, price corrections in some markets, and stalled construction projects.
The honest answer is probably both.
Some of this is genuine long-term scarcity. Some of it is speculative excess that could unwind if borrowing costs stay high and investors decide property isn't the safe bet it once seemed.
The generational divide. This crisis doesn't hit everyone equally.
Older homeowners who bought decades ago are sitting on huge, mostly untaxed gains, simply because they got in before prices exploded. Younger generations face the same job, the same discipline, and the same savings habits, but a finish line that's moved 5 times farther away. That's why homeownership increasingly depends less on effort and more on timing, and often on whether your parents can help with a down payment.
Could anything actually fix this?
Economists generally point to 3 levers: build more housing, the simplest fix but the slowest since construction takes years; restrict investor buying through taxes or limits, something a few countries are now testing; or keep interest rates higher for longer, though that makes mortgages pricier for everyday buyers too. None of these fixes are fast or painless.
What happens if it pops?
When housing bubbles do burst, like in the United States in 2008, it isn't a clean, painless correction. Prices crash, but so does the value of the loans banks issued against those homes.
Homeowners can end up owing more than their house is worth. Construction jobs disappear. Banks tighten lending even further, freezing the market completely.
That's the uncomfortable truth about housing bubbles. Even the fix can be as painful as the problem.
The bottom line.
Homes became unaffordable almost everywhere because of a perfect combination: cheap borrowing, limited supply, investor speculation, and wages that simply couldn't keep pace. Whether you call it a bubble or the new normal, the result is the same: an entire generation priced out of a milestone their parents took for granted, forced to rethink what building a stable life is even supposed to look like. If you found this useful, subscribe for more videos breaking down the economic forces shaping your everyday life. This video is for educational purposes only and does not constitute financial advice.